Budgeting is the bedrock of financial freedom. Time is not merely an enemy, it is your greatest ally. Investing secures your future. 3 times.
You know that story we're all told from a young age? You work hard, you save your money, and then one day you get to kick back and enjoy a nice long retirement. It's kind of the whole point of a modern career, right? But what if that story is becoming more of a fairy tale? In this explainer, we're going to dig into why that dream is slipping away for so many people and what that means for all of our financial futures. It's a really powerful dream, isn't it? But for more and more people, that's exactly what it is. Just a dream. We hear it all the time from folks who did everything right. They saved, they had good jobs, and they're still looking at a future where they might have to work forever. It really feels like the promise has been broken. And, the numbers, they paint a pretty bleak picture. Recent data shows that less than 30% of American workers are actually on track for a secure retirement. I mean, think about that. That is a staggering figure. So what on earth is going on? What are these forces that are making a once achievable goal feel totally out of reach? Okay, so the first and probably the most obvious culprit here is housing. For generations, owning your own home was the absolute bedrock of financial security. It was step one in any retirement plan. But that foundation, well, it's starting to look pretty shaky, especially for younger people. So let's connect these dots, right? You've got a majority of young adults still living at home, which pushes the age for buying a first house all the way up to 34. And even when they do buy, it's often smaller places, like apartments. Now, this is a huge piece of the puzzle, because for most people, a paid-off house is the cornerstone of retirement. It's the one massive expense you can finally get rid of. Let's just do the math on that timeline for a second. If you buy your first home at 34 and you get a standard 30-year mortgage, you're not going to be mortgage-free until you're 64. That is cutting it incredibly close to the traditional retirement age, and it leaves basically zero room for anything to go wrong. Okay, you might be thinking, but I'm investing in the stock market. That's my plan. And yeah, for decades, the market has been the other huge engine for retirement savings. But the fundamental idea that fuels it, this assumption of endless, easy growth, that's now coming under some serious threat. To really get why, we have to talk about a key idea: capital investment. See, in theory, this is how it's all supposed to work. You invest your money, a company uses it to buy better tools or tech, their workers become more productive, and that new value they create is what ends up funding your retirement. Simple enough, right? Let me give you a really simple analogy to see this in action. Picture 10 lumberjacks. Now, one of them saves up his money and invents table saws for the other 9. All of a sudden, those 9 lumberjacks are so incredibly productive, they can hit the daily quota all by themselves. The first guy, he can now retire, living off the value that his capital investment created. It's a perfect little system. But here's the catch. After the table saw, the next big innovation, I don't know, maybe a forklift, is a lot more expensive. And the one after that, a fully automated robotic arm, is exponentially more expensive. You start hitting this wall of diminishing returns, where creating real new productivity just gets incredibly hard and incredibly pricey. And this is where things start to get weird with investing. Money starts to flow away from these productive assets, like new factories or table saws, and it flows into non-productive assets, like real estate. These things don't create any new value, they just shift existing value around. And what does that do? It drives up prices and makes that housing problem we just talked about even worse. But the problem is actually way bigger than just a shift into real estate. All assets, including stocks, are getting crazy expensive compared to the actual income they produce. Just think of our lumberjacks' table saws as shares in a company. What happens when the price of those shares goes through the roof, but the value they're creating stays the same? We can see this plain as day with a metric called the price-to-earnings ratio, or PE ratio. Just think of it as the price tag of the market. Historically, you'd pay about $15 for a stock for every $1 of profit the company made. It was a pretty solid relationship. But today, that price tag has soared. Investors are now paying around $50 for that exact same dollar of earnings. So, what does this actually mean for you? It's simple. And it's brutal. For the exact same amount of retirement income, you now have to save and invest about 3 times as much money as previous generations did. The goalposts haven't just moved, they're in a completely different stadium now. So this isn't all just happening in a vacuum. An economist named Robert J. Gordon argues that these are all symptoms of a much bigger shift. He's identified 6 major headwinds that are basically slamming the brakes on the kind of explosive economic growth that our entire retirement system was built on. Gordon points to 6 huge forces acting as brakes in our economy: shifting demographics, education leveling off, crazy inequality, the pressures of globalization, the big energy transition, and of course, a massive overhang of debt. Now, any one of these would be a major challenge, but when you put them all together, you get a perfect storm that calls into question the very idea of endless growth that our retirement system needs to survive. Let's just run through these real quick. First, demographics. That huge economic boost from women joining the workforce in the 20th century, that was a one-time thing. It's over. Second, education. College costs are through the roof, but the economic bang for your buck just isn't what it used to be. Third, inequality. Any growth we do see is almost all going to the top 1%, leaving pretty much everyone else behind. Fourth, globalization. Great in some ways, but it also puts a ton of downward pressure on wages here. Fifth, energy. Moving to new energy sources is essential, but it's going to be a massive, costly project. And finally, debt. Government and personal debt are at historic highs, and that debt is a constant drag on future growth. Each one is a major hurdle. So when you put it all together, the housing hurdle, the stock market paradox, and these 6 massive economic headwinds, a completely new picture of retirement starts to take shape. And it's one that looks very, very different from the one our parents and grandparents experienced. So what's the bottom line here? The financial playbook that worked for generations, it was built on one single assumption: that the economy would just keep growing like crazy, lifting everybody up and making retirement pretty straightforward. Well, that core assumption is now seriously in doubt. All of this leaves us with a really profound and honestly a pretty personal question. If the economic tailwinds that helped our parents retire have turned into headwinds for us, and if the old rules for getting ahead just don't apply anymore, then what are the new ones?